my wrapping of 2025 was the noise is noisy.
Yeah.
And stick to what you know moves markets really in the long term, not on a daily basis, not when you come in the futures market. The noise is noisy for 2026. I think the noise continues to be noisy, and maybe we push the envelope. But ultimately, a lot of this is going to be seen as noise.
Right.
There is some risk of long-term degradation here as you get something of a bull market in populism for both parties, that the policies themselves that have sort of brought us here may not be here, but I don't see that. Like, I still see a very strong year. I see 14% earnings. What I see in markets this morning, which is fascinating, is, we thought that tech would not be the leader this year. It would be the more cyclical sectors. Right. And you're actually seeing it this morning. What's getting hit the most? It's NASDAQ. And it's not the S&P, it's not the Dow.
I get into the math, and Kudlow and MO, or Larry McDonald's great comments on the wall of money out there. BNY Mellon is expert at this. The overwhelming keel to this market is billions of dollars. It's got to find a warm spot to go.
It has to find a warm spot. And by the way, it's been coming to the U.S. And so all this talk about Sell America back in April turned out not to be true.
Mm-hmm. And so when we're going to continue to see the shift, you say, out of the Mag 7, broaden out this rally. That would be nice, wouldn't it, in 2026? Where do you see the leadership coming from, though?
So the leadership, I think, here, even with the financials selling off this morning because of some of the policy proposals that we've seen and, of course, the news this morning about the Fed, I still think it's financials because we still see a steeper yield curve. And we also think it's industrials. And we also like down cap as well, particularly in the financial sector because—
What did you call it?
Industrials. Down cap.
Down cap.
Down cap. So in other words, mid and small cap companies.
Okay.
Okay. So down cap from your $4 trillion company, you've got a lot of industrials and—
Did you just coin that? I've never heard of down cap.
Did I make it up?
She's gifted,
We're going to go with it, though.
Okay, down cap, right?
Okay.
So we're not talking about the Mag 7 anymore, but we're talking about— if we're in an M&A world, if we are in a deregulatory world, which is, by the way, pushing the multiples on the financials as well and price to book, then where are you going shopping? You're going shopping in mid-cap. So you're not having two giant companies merge, but you're having more M&A in the mid-cap section. So we like that as well. It's just a more interesting market than we've had, right? And in the end, if you think about what happened last year, the Mag 7, which I don't know if we should even call it that anymore, only 2 outperformed the S&P, and the S&P was still up. Total return, the S&P was up about 18%, including income. So that's a pretty decent, fabulous year. And so we can live in a world where companies are earning better than they did 2 or 3 years ago. Rates are coming down. We're getting deregulation in the energy and financials and industrial sector. What don't I love?
Okay, so the
what don't I love?
The bombshell this weekend's Feroli over at JPMorgan says maybe we won't see any rate cuts. Other people, 2-3 rate cuts. Mr. Myron at the Fed is looking for 6 rate cuts. Do you just assume money market yields are coming down?
Yes.
And then the question is for BNY, for the people who enjoyed 5.5 and now they're joining 3.x, what do they do with that capital?
Look, we've been saying this for 2 years here, right? That you have to think about the reinvestment risk in the T-bills and on the cash side. And we've been telling clients to move out in duration into the belly of the curve because that's where we see the most value here, and you'll get the benefit of the Fed cutting as well. So that's what we've been telling clients to do with the cash.
So you talked about down cap, mid caps. Small caps had a really nice year, didn't they? Right?
Did.
Russell 2000, I think last check was up about 13% for last year.
It closed in with the S&P by the end of the year.
Exactly. So is the S&P going to have a little competition in the way of small caps this year?
So I think it could. We just see a much broader market. You're going to, the talk about concentration is also about what starts outperforming. And I think if you just have a pause, right, in the multiple expansion in the top 10 stocks, let's say, and the capital goes elsewhere, you have a world where international does well, emerging markets does well, small and mid do well as well. And you can still make a lot of money, but we have fully allocated portfolios. In the end, we fully allocate. And so this is a world where all those allocations can do well.
If we lost perspective, I look at the WEI screen at EM, the Damien Sassar world, like up 50%, up 30%, or that. Can we remind everyone that we're trying to make nominal GDP plus 200 beeps and like 8% per year, 9% tops is your normal equity return? I would suggest.
But it hasn't been.
No, but we've lost perspective on the theory.
We've totally lost perspective. The average annualized return in the S&P since 2010 has been 12.5%. Okay. That is so far beyond what asset allocators are looking at for their capital markets assumptions. It's just,
okay,
and so the question is, are we going back to a world where rates are higher, where real yields are higher, right? Can you still assume you're going to get that 12.5% average annualized return?
Do you buy the Goldman? You're going to love this. Do you buy the Goldman Sachs linear extrapolation off a y-intercept that gets you way out to a single-digit return for S&P 500, like low single-digit return, because we've done so well recently?
No.
Why?
No, because I just think we're in a different market. We're in a market where we've got a 14% operating margin for the 500 stocks on average for the S&P versus the 9% 20 years ago. Are you just in a different?
See how she changes? You should have seen her with a slide rule.
So,
very smooth, Alicia.
We think you're in a structurally different market. Productivity, 4.9% last quarter. We're in a world where there's productivity everywhere. It's showing up in corporate America, showing up in the data. Of course, you're not going to get 2% returns for over the next 10 years.
If she had a Dixon tie
I'd
kind
throw
of
it.
throw it at me.